Good morning again to our wonderful audience out there, and welcome back to Boutiques on Wednesdays. There are many ways to construct client portfolios. Some of us might follow a building block approach where you pull the levers on asset allocation and the things like that, while others might be looking for good multi-asset mandates where managers can pull all the levers from asset allocation to onshore, offshore allocation and security selection. Today, we will have a look at two of these multi-asset flexible mandates that prove that we can create, or that prove that they can create wealth for clients in doing exactly that, finding the best investment opportunities locally and globally across asset classes through various cycles. The first fund that we will look at is the Visio BCI Actinio Fund, with a phenomenal track record since 2004, and followed by the Granate BCI Flexible Fund, also with a solid performance record since inception. Our presenters this morning needs very little introduction to our audience, and it's my absolute pleasure to welcome Patrice Moyal from Visio and Heno Vermaak from Granate Asset Management. Good morning, Patrice. Heno, thank you so much for your time this morning. How are you doing?
Good, thanks, Eugene.
Good morning, Eugene. Thank you very much.
Yeah, thanks for joining us. It's always great to have you with us and looking at very insightful presentations this morning. Patrice, you're up first, so you can start sharing if you're ready, and Heno will follow you. And to our audience out there, you know how it works by now. After both presentations, we'll do a Q&A, and you're more than welcome to post those questions in the Q&A bubble, and we'll try to get to as many of those as we can. Patrice, I see you're ready to go. Thank you, sir.
Okay. Thanks, Eugene, and thank you, BCR, for the opportunity once again to present on some of the stuff we do. This is just a brief, so I've got 15 minutes. Please keep me in the loop because I can't see my clock at the moment. Firstly, this is what we look like, and clearly you can see there's been a pretty long track record and a bit of experience amongst the team, so nothing too new here. Visio Actinio Fund was the second fund we launched after our first hedge fund, which was in 2003. This was a 2004 launch, and really to replicate the long-only position in our hedge funds back 21 years ago. Actinio is a short for actinium, which is an isotope that you handle with care, and that's exactly what we've done over the past 20 years or 2 decades with the Actinio Fund, and it really has paid off over the period, as you'll see in the next slide. It's generally it's absolute returns. We're not benchmark cognizant. We concentrate the portfolios, and we've over the years been able to delve into all sorts of things. We bought corporate bonds when they were smashed in 2008 and 12. We bought ETFs in platinum at one stage. We've even got 5% in India index at the moment since 18 months ago. So we really are able to do interesting things in the fund. The performance of the fund, as you can see, has been pretty satisfactory over the past 2 decades, and I must thank our loyal customers there. Some have been in for a long time, and clearly we aim to continue to do that going forward. In terms of performance numbers, you can see those. The slides will be available. I think it just talks to the ability, the benefits of concentrating portfolios, and also concentrating more on absolute return than actually trying to mimic an index and dance around an index. We really focus on individual companies, individual shares, individual themes. In terms of I'm going to concentrate on a few things because there's a lot to talk about, but I think I want to just focus on some themes and ideas that we have that are in the fund. Firstly, there are 25 holdings, plus the 26th is 20% position in our global equities fund, so that we don't have to have 40 or 50 shares. We can keep it tight. And in our global equities fund, we've only got about 25 positions itself. In terms of the themes, there's everything from what we prove, the proven offshore. So we like process, which is nice, which is 10%, BHP, Anglo Gold. You have to have some gold in this environment. Domestic champions, again, Sea Harvest to this point hasn't proven to be one of those, but certainly Afrimat, Invicta, good solid industrial businesses, especially post-election. You want some infrastructure exposure. And then special opportunities can range from financial services to paper and packaging And this gives you a taste of what there is. And in property opportunities, given what's happened post-COVID, all these companies are all restructuring in one form or another. We saw it with Fortress, and then we got Neppies, which was a great success for us, the Fortress Bs. Fairvest has been in constant rejigging, and when they absorbed Arrowhead, we were involved in that deal. We had 10% of Arrowhead at one stage and 5% of Fairvest. It's been a tremendous investment. It's more than doubled since COVID, even pre-COVID. And we continue to enjoy the work that Fairvest is doing. And Harprop, I'll talk to very quickly. It's a short position. It's a most recent position in one of the most recent positions in our fund. Again, focusing, some of these will be a bit of repetition. Here's the makeup of the Actinia portfolio right now. It's fairly dynamic, but I think it represents kind of our house view, or certainly from an absolute return point of view. We do believe that there's great pockets of opportunity in SA. The offshore has always been a large component because we are able to identify good opportunities overseas, and some of it is actually domestic stocks like a Granate, which is a rand hedge, so we can at least enjoy the benefits on the JC. I've put here letters to boards. These, in every instance here, we have been, or we are currently involved in engaging with the boards. Alexander Forbes has been ongoing. It's been a tremendous investment for us, and we are one of the largest remaining shareholders there. Metropolitan has been a 2-year investment, and it's given us plus 90% return. There's some figures here. We've also written to the board more recently, and we had some good feedback from them. But you can see the performance of the shares. So we really are backing the company in what they're doing. Nepi is a result of getting those shares from Fortress B and a lot of engagement there. We were involved in the de-REITing of Fortress B along with some other key shareholders. Afrocentric's an interesting one, which I'll talk to very briefly. At the moment, it's not returning anything interesting, but we did sell most of our shares at 6 Rand a share. They're 2.80 Rand now. Sanlam owns 60% of the company. It's going through some restructuring, but you don't do 100% of the work for just 60% of the benefits. Again, I'll focus on some of these event-driven, and this is what Actinia is about. We like to focus on individual companies. Some of it will be theme-specific, but otherwise it will be really very much bottom-up. Again, Alexander Forbes, it's just been a tremendous return since Dawie de Villiers took over about 4 years ago. And it's a great cash generator. It's just, there's scalability. There's margin improvement because you can grow your asset base, not necessarily your costs. And they've focused on the core business, and they've pretty much dispensed all the other small stuff. And there's a much greater relationship with Sanlam than before. Recent investments, there's some slides on Harprop, not on Tigers, and not on Pick and Pay. But these are 3 recent investments we've made. Why? Because in each instance, it's very much potential to extract from within. We don't necessarily have to rely on top-line growth because there's very little at the moment here in SA. However, in each instance, management can make a difference to the return profile. Harprop is one case because it sits within South African assets, with Eastern European assets, Central Eastern European assets, and with some sub-Saharan African assets, Nigeria, etc., which they're selling. So there's a disparate bunch of stuff there that together make up more than the share price, and management is intent on fixing that. And we've seen that time and time again. Afrocentric, well, it's a different story. It doesn't make sense for this thing to be listed anymore. Highly cash generative, Med Scheme, Bonitas, great businesses. And Sanlam wants to integrate medical services into their own massive ecosystem. Pick and Pay, recent investment, we've avoided it. We were short in the hedge funds up until beginning of this year. And we do want to give the benefit of the doubt to Sean Summers, plus the 8 billion that he's getting. So it can't really go too wrong after that. So you're getting optionality on the core. In other words, the problem businesses. Boxer should be a good listing. It's a great business. And then hopefully they'll take the hard medicine on everything else that's in Pick and Pay that's not working. And Pick and Pay clothing is also a good business. So we're not paying a lot for the optionality here. So we've gone from 0 to 4. In the case of Tigers, another story. We've known Charles Kruger for nearly 2 decades. And much of the problems at Tiger Brands emanate from the market share gains that Premier Foods has made at the expense of Tigers. And who's now running Tigers? Well, the ex-CEO of Premier Foods. So if you want to know where the opportunities lie at Tigers, it's nothing better than to have the CEO of the company who took up most of the market share. So I think we can, and Tigers have got some activist shareholders in the form of Value Capital on the board now, which we support. So these are good new positions. Harprop, Tigers, between the three of them, you've actually got almost 10% new exposure in the portfolio. The one key one that we've been invested for 18 months now is Granate. This is ready to benefit from Pensions Corp in the business that they do in the UK. This is more theme driven, because in this fund we also hold a company called Just Group, which is the biggest writer of bulk annuity business in the UK, but it's the biggest writer in terms of number of deals, but it's the smallest in terms of size of deals. But there is close on £1 trillion of defined benefit plans sitting with corporates that they want to move off their balance sheets in the UK. It's been going on for 2 years. It'll carry on until 2030. It's 50-60 billion pounds per year is being moved off balance sheets of UK companies onto life assurers and writers of these bulk annuities. So Pensions Corp is something that Johan Rupert has been nurturing within Granate. He has a 49% stake in Pensions Corp. It represents more than half the NAV of Granate. The NAV of Granate is over 650 Rand. The share price is trading at 470. It's a 30+% discount to the value. So assuming one day they realize the value of Pension Corp, which we extrapolate that by 2027 will be 80% of the value of Granate, by virtue of just growing Pension Corp and the cigarette business not growing much, it's a tremendous opportunity to get exposure to a growing, very key theme within the UK. I mentioned we've also got Just Group in the Actinia portfolio, and we've got Legal and General. So we are exposed to that, what they call pension risk transfer theme in the UK through 3 different animals. Just Group is up 32% since we invested in it in July last year in pound terms. Pension Corp is up about 25% with some dividends. And then the Legal and General actually is flat because we did receive a 7% dividend. So we still have good opportunity there. Alexander Forbes, well, if you can pick up some shares, there aren't many left to pick up because the free float 16%. Us ourselves hold 6, PRC's got 6, so that's 12. And there's 2 other shareholders which each hold about 1.5%. So there's little left here. We don't quite understand why it should still remain listed, but for as long as it is, we'll enjoy the benefits of it. And in the meantime, we're getting great yield, great upside to markets, and a mix of domestic plus offshore exposure. So I'm not going to talk more on Forbes. You do know what it's about. Harprop, interesting, not huge upside as it stands currently. We weren't the first in town to buy it. We haven't written anything to the board yet, but we're certainly engaging with the shareholders. We think if they're able to sell the sub-Saharan African business, the Nigerian business, it's small in the scheme of things, but it'll release some cash. It's a precursor to cleaning up the rest of the portfolio. The South African property group really needs to focus domestically, focus offshore, but just clean up its sum of parts. The NAV discount here is close on 50%. So there's once between the upside between the shares and where the NAV is, and the opportunity to actually optimize this portfolio. And in the meantime, we're getting an 8% yield. So we're getting paid to hold and enjoy the optionality that should come from a recycling of the assets. Metropolitan is not a new investment. It continues to perform. It had a capital markets day last week. It was a better reaction by the market than we thought. The share was less than 24 Rand a share. It's over 26 now in the space of a few working days. We still think that if they focus on what works and get rid of what doesn't work, there would be more upside. But for now, at least, they've put some hard targets down. And if those targets are met, the share price will continue to rise at the current rate. But in the meantime, we very much want to see the intersection of the business actually perform to expectation or better. And we still think that the next 6-7 years, the India business could be bigger than the whole of Metropolitan, and that's the Aditya Birla Health side. I went to India last year, October. I'm going to India again next month for a week, just for a series of meetings, and this time in Chennai and Mumbai. We're really excited about India. Unfortunately, hard to play individually, but through companies such as Metropolitan Momentum, we can, and obviously direct exposure through the index. I'm kind of running out of time. Have I got much time left, Eugene?
Yeah, you're still good, Patrice, for 2 minutes or so.
Okay, thank you. Are we going to just ride on our coattails here a little bit? If you look at the share price of Metropolitan Momentum, it's not Metropolitan, it's Momentum, really. That's the red line. And you can see just what the outperformance has been. Credit to the old CEO, credit to Granate, the new CEO. Jeanette's been in there for just about a year. And then obviously Risto, the CFO, who's been there throughout the period. Great capital allocation decisions, great strategic moves so far to dispense with things that are not working, outstanding disclosure, and the buybacks that have reduced the share count we've put here by over 5%, and they've returned the equivalent amount in dividends. So they really are doing what a life insurer should be doing, especially in South Africa where it's so commoditized. And then obviously the India exposure is a tremendous opportunity. And as we say right now, it may be worth 25% of the share, but we think that if it grows at the clips that it's growing at, that 25 can be 50%, and in 6-7 years' time could actually be 100% of the value of Momentum. This from an offshore, not to ignore it, it's over, as you said, 40% of the portfolio itself. This is just a makeup of the shares that are held either directly, such as Adjust and the Legal in General, or indirectly through the offshore fund. And that's got a great bunch of companies in there, some optionalities, some, let's say, speculative stuff, some boring things like Otis, which is lifts, but it's really a boring but in good business. I listened to Microsoft this morning. I mean, I talk about the opportunities, the key themes. Given that I've got 2 minutes left, just very quickly, I listened to Microsoft's results this morning from last night. And despite the share price moves, which, I mean, they were down 4% off the market, this is just pretty much noise. I mean, just our bill alone per year at Visio is over $300,000. It's a utility. When people say, what are utility bills you pay every month? Well, it's electricity, it's water, it's maybe internet, but you forget you're paying Microsoft every month. And you're going to be paying Microsoft every month probably for the next couple of decades, like you have been for the past 2 decades. You've been paying them something every month. It's a great utility, great services. It's expansive in terms of all the things they're doing. It's an additive to your business. It's enhancing to your processes. It's enhancing to your ability to do business. And it's expanding your knowledge in terms of the open AI stuff that they're doing now. So it's really just an incredible business. Strip out the noise, the monthly noise. And so their cloud business didn't grow about 30% and grew about 29%. So there was a slight bump in the expectation. So the share price drops a little bit. But ultimately, we're going to still be paying that utility every month, every year, and it's growing. So these are just some ideas that are in the fund. We could go into detail on each one. I want to just focus also, Japan has been in our funds for 18 months. It's a number of small shares, as you can, small companies that make up the bulk of the 7%. In India, you can see the 4%. We very last quickly on China. It's not investor friendly as it appears to be right now, but just bear in mind, and Alibaba is on a 9 multiple. The second biggest merchant in India, called JD Group, is on an 8 times multiple. Tencent's done well on the 16 times, which is still below its long-term average. So you are not paying a lot of money right now for Chinese stocks. So any pickup in consumption in China, you could see a massive re-rating in Chinese stocks, and they'll still be, cheap and may remain cheap because it's China, but they are seriously cheap right now. So don't ignore China. I'm going to stop here because otherwise I'm going to go into Hanno's time. Thank you.
Many thanks, Patrice. If you can stop sharing, Henna can start sharing. If you
Sure.
can stay on the line, there's some questions coming in. We'll deal with that after
Yeah.
dinner.
There you go, Eugene. Can you see the slide?
Not yet. I just want to check, Patrice, that you stopped sharing. There, yeah. And Henna, your slides are coming through. Got it. Perfect. Yes.
Well, thank you very much, Eugene, and thank you, BCI, for the opportunity to speak to you again. When we saw the theme that you wanted to talk about, it coincided with me presenting at a different conference where we were asked to describe our investment process as a culinary dish, which is a weird question to answer, but after some careful and colorful consideration, we kind of realized that our process is best presented not by anything that you find on the standard menu. In fact, we try to produce the chef special or the dish of the day that tends to be scribbled on the blackboard on a daily basis. So why do we think that's the case? Now, if with some artistic freedom, we consider our investment team as the kitchen staff in a restaurant. And we have a group of people from different areas of interest, different skills and different backgrounds. But we all work together ultimately for one goal, and that is to produce this dish of the day. The most enjoyable plate of food possible. And ultimately, we aim to nourish and delight everyone that's coming to our restaurant. How do we do this? Every day, our team goes out to find ingredients for us to use in the kitchen. Now, we have a very clear idea of what we think or what we regard as quality ingredients to consider. But we also know that even the best ingredients needs to be ripe before you consider including them in the recipe. So our team casts a wide net. A few of us go to the garden to harvest, a few of us to the forest to see what nature provided overnight. Some of us focus on the town market to see what local farmers produced, and some go to specialty stores to source those special ingredients that we need. We also have a few people looking into our own pantry to see if there are ingredients that we've missed or something that's entered the optimal aging window for use. Now, once we have found what we like, we bring them all back into the kitchen, and this is where we think the magic happens. As a team, we then consider the different elements available to us, and we start to design a dish that combines the best that we have in front of us together with the best we have inside of us. We consider all the potential options we have, and then we try to play to our strengths. And with the benefit of the whole team, this dish starts to take shape. Our dish always starts with quality ingredients, but we ultimately aim for a dish where the final product is better than just the sum of the parts. And we are mindful that it might take time to produce. So we follow a very iterative process through which we combine these ingredients, we taste them, we adjust where required, we add things that are missing, we balance and we taste again, and we do this over and over again. And in the process, we try to utilize everyone's palate to ensure that this dish is optimally cooked, that the seasoning is right, and everything ends up in balance. So sometimes our dish looks quite different at the end compared to what we thought it might be at the start. And we think this is quite rational. We adjust to the ingredients, we adjust to how they work in practice, we adjust to the outside environment. We don't force ourselves to stick to only Italian recipes or to produce steakhouse classics or only to bake pastries. Our dish will always be the best that we can produce from the ingredients that we can find today. And ultimately, it's also a reflection that our process adheres to one of our other fundamental beliefs, and that is that if you combine the highest quality ingredients and you mix it at the right time and you cook it according to time-tested methods, you'll deliver the type of meal that we want to serve to our friends and family and also eat ourselves, and do that every day. And in that way, we try to build the Granate Flexible Fund. What do we regard as quality? For us, the first most important question to ask is whether a investment instrument is of sufficient quality. And the things we consider in that regard are 4 hurdles that we want to pass. The one is whether the governance around the instrument is sufficient to protect us as minority shareholders or minority holders of the instrument. The second is the balance sheet strength. We want to ensure that this ingredient has got sufficient robustness to keep its positive elements through the cooking process. We look at the management track record. We're looking for management that have a proven track record of rewarding investors over time. And lastly, we focus on the cash flow sustainability of the businesses. Those 4 elements are what we regard as requirements for a business to compound over time. It's the elements that increases the likelihood of a business delivering on its potential, in the same way that good quality ingredients could deliver on its potential. The second question then we ask is this specific ingredient ripe and ready for inclusion? And in that regard, we follow a process of a cash flow based valuation to calculate what we think is a fair or suitable price to pay for this instrument. We consider whether the market price offers us risk compensation compared to that intrinsic value that we've calculated at the time. And then we see how it fits together into our asset allocation framework as a whole. So now we've identified the ingredients for our dish. We start to get to the process of cooking the meal. For us, this is an iterative process. Because we start with quality ingredients on an individual basis, all of which we expect or we believe deserves to be included in the dish as a whole, we are seen as being bottom-up investors, but that's not the full picture. We have a bottom-up focus, yes, but then we consider how these individual components work together, and we consider diversification and concentration within the portfolio. And we also consider the relative valuations as well as the absolute valuations of these companies and instruments that we've selected into the portfolio. We add a bit of top-down thinking to the mix in the same way that you would add salt to a dish to ensure that you don't end up with a bland portfolio. We know that in certain seasons, certain ingredients are not ready to be consumed, and hence we have got a top-down check around everything that we do as well. And then lastly, in terms of the monetary backdrop, it's important to point out that we don't try to predict what will happen on the macro side, but we do try to be aware of what is happening. If it's a cold winter's day, you want to be cooking a hearty meal. If it's summer, then you might look for something light rather to serve. And that's the way we think about the macro environment around everything that we do. We are in a very fortunate position that we are one large investment team with many different skills and experiences, everything from the money market instruments, fixed income credit, property, equity locally, and offshore experience. And all of that is included in our decision-making process when we build this portfolio. Everyone has got a voice around the table. Everyone has got a palette with the ability to identify and improve on the portfolio, and we utilize that as much as possible. So on this slide, we kind of show a movie of the ingredients that we've included in our dish over the past 4 and a bit years that we've run this portfolio. As you would expect, this is an absolute focused portfolio with an inflation +6 benchmark. So the largest components over time are risk assets, and by that I mean domestic equity and foreign equity. But it's very important to see that there are many ingredients that feed into this dish. We aren't limiting ourselves to any region. We're not limiting ourselves to any asset class. we don't believe that the best investment opportunities are just limited to the JSE, and hence we allow our analysts to look at any opportunity that they might find that could be interesting, that would pass the 4 pillars and would be additive to the dish. An example would be if you look at the light orange second from the top, that is inflation-linked bonds that we've had in the portfolio. Initially, it was a material component to the portfolio. Recently, it's a lot smaller. It's our opinion that you get better bang for your buck by looking at property locally and offshore. And we're more comfortable holding a component of nominal government bonds next to that. Our domestic equity component, the dark purple or pinkish one, used to be very large. And then when the regulations changed, we had the ability to increase our offshore allocation, which we did. And hence offshore equities and offshore property grew materially in its mix into the portfolio. Going from the movie to the picture, this was the daily dish on the 30th of June 2024. Around a third of the portfolio was invested in domestic equity positions. We are quite excited about the opportunities that SA Inc. and specifically the medium-sized companies in South Africa are offering. We are optimistic about what a government of national unity might be. And that's combined with the fact that the expectations in South Africa were so low that even a less bad outcome might be a very good outcome for your portfolio. We still have significant exposure to offshore equities at nearly 30% of the portfolio. And the next largest component is the property book combined at about 17% of the portfolio. 6% of that's domestic property and 11% is foreign listed properties. We've got around 15% in government bonds. And at the top, you'll see that there's a whole range of spices that we add into the mix. That's where we benefit from working very closely with the fixed income team that can identify opportunities that's outside of at least my historic experience. So going from the dish to the individual ingredients, then again, here we've got a list of our top 10 local and top 10 offshore holdings. As I said, we are excited about the opportunity set in South Africa Inc. And there we'd include Capitec, Nedbank, Shoprite, Mr. Price, Udeka, and Coop Agri as examples of companies that we find attractive. In terms of property, locally, Growthpoint and SA Corporate score highly in our portfolio, and that's mixed with Unibel, Rodamco, Dermot London, and a few other European and UK listed property names. On the offshore side, we still have significant exposure to the semiconductor industry. We see that as a phenomenally well-positioned growth vector in the world, and we can identify some companies with very strong competitive advantages in that growth vector, and that's one of the ways to really make a good dish in the long run. We also have some exposure to holding companies, the likes of Exor included in there. That's the holding company of businesses including Ferrari, Philips, Stellantis, Case New Holland, and a raft of small venture capital and early stage investments. Overall, we think with these components combined, we'll deliver on our benchmark and ideally then some. But if we zoom out to the proof ultimately, how did our dish taste over time? We enjoyed it. We are very pleased and very proud of the portfolio's performance to date. It's still a short period. It's only since February 2020, but over more than a 4-year period, we've comfortably outperformed our benchmark, as I said, being inflation +6. And similarly, the dish next to this is the Granate BCI Balance Fund, which also performed very well compared to its benchmark over time. So Eugene, with that and with the best wishes from the team in the kitchen, we thank you for the opportunity.
Good team of chefs there indeed. If I look at the performance numbers there, so well done on that. Hino and Patrice, if I can maybe start with this, we'll get to the questions from the audience just now. It's that ongoing debate between, if you look at SA nominal bonds and SA equity. I mean, SA bonds had a phenomenal run in June. Both your teams have very, very strong fixed income teams. And you did make mention to your fixed income team run by Bronwyn Blood. Patrice, we've seen several presentations from Jonathan on your side as well, doing phenomenal work. But do you think we may be at an inflection point between equities and fixed income in terms of near-term overall relative to performance? I seldom do this, but I actually want to check the views from the both of you. If you want to maybe go first.
Yeah, I mean, you're trying to get me to predict, and that's something that doesn't often happen. Ultimately, and it boils down to the odds of success going forward. And our current portfolio is a reflection of the fact we think there's room for both. One of the biggest elements or benefits of a flexible mandate is that you're not forced to choose. You're not forced to be exclusionary. You can include both. So where long bond yields are in a real basis, it gets very close to what our benchmark is, and with a little bit of revaluation or yield decline, you'll get very good returns from a bond portfolio. But I would suggest that a similar argument will be made for SA exposed equities. The valuations are low, the yields are high, the cash flow is there, and you've got certain management teams that are very active in unlocking some of that potential.
Yeah, Eugene, very briefly on my side, there's definitely opportunity to park cash in bonds, and there's been some interesting returns so far. But you can find shares that are paying you to be invested. I mean, I mentioned a high profit and 8% yield. We just got a 16% dividend from Alexander Forbes. Okay, so it's half of it is a once-off, but even APSA, for our sins, we're holding APSA right now. But by the way, we wrote a letter to the board 3 weeks ago, and we're not happy with some management actions, but you're getting a 9% dividend yield. So there's some value in the bonds, but with interest rates potentially coming down, we've got nice leverage on individual equities that are paying good yields with the opportunity to extract further equity value. So at the moment, we still prefer being in the equities.
Thank you. Staying on financials, Heno, you've had Capitec in your portfolios for some time now. It's worked extremely well for you. Still hanging on to Capitec as a big contributor to your fund?
Yeah, definitely. It's, as I showed, it's the largest local exposure in the fund. We think the growth potential is still there. It's a business that's very well managed. It's a business that's got very strong position in the market. And it would be wrong to think back to Capitec in the days of just being a micro lending business. This is a diversified financial business that is entering a few large profit pools now with business banking and with life insurance. And we think and we expect them to do a copy and paste job of what they did in retail banking and to succeed in that. And that would lead to a phenomenal growth in the underlying or the bottom line profits for this bank.
Thanks, Heno. Patrice, you showed your geographical exposure of the fund in a great schematic. That exposure to Japan, very interesting. I think, especially on the global front, your carve-out looking a lot different to a lot of managers out there. Japan, you've got 7% exposure, and it had a phenomenal run. If I just look at the overall market, you're obviously a sharpshooter, so don't buy the market. Also note that Japan increased their short-term interest rates, I think yesterday, to 0.25%. Can you maybe just unpack that Japan exposure? We know the yen is still very much undervalued relative to the dollar, but some may say that Japan is getting pricey. The equity market's getting pricey. Maybe from a stock specific perspective, your views.
Okay, so we're not going to profess to be the best at picking Japan. We are value driven. As far as we can see, individual companies in Japan, some which are geared to a weaker yen, some which are not, are still offering tremendous value because of the sum of parts which is still higher than the individual share prices. There's still a lot of cross shareholdings within these companies. Some are being unwound as we speak. There've been record buybacks by many of these Japanese stocks. I think 2 of the 7 that we hold have still not disclosed their full strategy as far as unlocking their cross shareholdings, etc. They are, I think, either been blacklisted or grey listed. In other words, the Tokyo Stock Exchange itself has taken the initiative to actually grey list companies that are not yet meeting governance shareholder expectations. So they really have been proactive. We've seen good returns from the other Japanese stocks. In fact, we've concentrated 3 of them up, and we sold 3. We used to have 10, we're down to 7. So ongoing return expectation is still very good, irrespective of where the yen is going, because to be quite honest, we are not going to call that one round.
Yeah, exactly. Back to currencies. I mean, we can't cut it or can't call it. Very topical at the moment, or still topical, Patrice, is expected rate cuts on Fed level. Big consensus the market at the moment that the first rate cut's going to come in September. I'm not going to hold my breath. I've seen how we've all got it wrong so many times. But you have to wonder what the impact can be on global markets, especially US markets that are a bit frothy. Is that potential rate cut already priced into markets, or do you reconsider recalibrating your global exposure?
Again, in fact, I listened to Howard Marks's comments from Oaktree this week, and he said whoever called for rate cuts in 2022 and thought they were going to happen, divested from the market, and they lost out on almost 50% return. Those who stayed in the market, thinking there weren't going to be rate cuts, we've benefited. So, you know what? We must focus on the individual companies, on the themes. There's a tremendous amount of opportunities, both in the US, which are not even rate sensitive, in terms of energy generation and infrastructure spend, which are necessarily going to happen. So as long as, for example, Allison Transmission that we've invested in, amongst other industrial companies that we are starting to put money in, even we're looking at GE Vernova very carefully. There's a couple of slides further down the pack on that. So we are pretty much discarding whatever interest rate views are, and let's just focus on important themes.
Sensible indeed. Thanks, Patrice, for that. Heather, I'm going to pass the next one to you. Also very topical. We get it from our clients so often. Ample articles being written in the papers about the US elections and what the impact potentially will be, whether it's a red or blue regime on specifically US equities, will it remain frothy? Can that market keep on going? And what does it mean for other emerging markets, especially places like South Africa? And if you were to see a red regime that side, will it have a knock-on effect on SA? Your views and your thinking around it, or is it also a case of, focus on what you buy?
Yeah, it always is, and that's thank you very much for giving me that easy answer to a very difficult question. We do believe that it's very difficult to call big events like elections. And it's doubly difficult then to call the market reaction to those big events. And when Trump was voted in the first time, for a few hours it was disaster, and for a few years thereafter it was happy days in the equity market. I would have been wrong in predicting the election outcome at that stage, and I would have been doubly wrong in predicting what the market reaction to that would have been. And hence, we definitely don't try to do that, and we definitely don't position our portfolios for binary events like that. In fact, we try to build portfolios that should deliver over the long run, irrespective of political regimes and outcomes like that.
Thanks, Heno. Let's move on to property. You've had a big position to global property as well as SA property. a lot higher than the bulk of the market. But I still see it's very high positions in your portfolio. It worked well. Are you retaining those positions? Do you intend to increase, decrease? Where do you stand?
Well, we're definitely always looking for more opportunities around a theme that we've identified like that. That's the way that we built out our semiconductor exposure over the last 5 years. Property is a more recent exposure. The beauty of property is that you are dealing with very long cycles, and this cycle has been very negative for quite a while. The property companies that we are invested in have got strong balance sheets, so they've got longevity in riding out the cycle. However, we do believe that for most of them, property revaluations have bottomed, and from here onwards, we should see positive mark-to-market increases on the properties. It's possible that interest rates might decline going forward, and that would make it a bit easier for these properties down the line as well. And then lastly, it's trading at incredible discounts to its written down net asset values at that stage, which means that you can get double-digit yields from international property exposures that are very well placed and quite unique in many instances.
Yeah, and that opportunity in particular, I see you started increasing local property on your fund as well. So definitely some opportunities there. Patrice, I maybe want to end with the very last question, and I'm going to hand it to you. And, you know, that's almost where we came from the past 12 months and where we're going the next 12 months. You know, a recession risk is not totally off the table. There's still some talks about a potential soft landing. But the question, I think, with a lot of investors, you know, if we look at what's happening with equity markets and anticipated rate cuts, you know, is it all guns blazing, a risk-on argument so we can go full throttle, or is there still a lot of reasons to remain cautious where you can? You also mentioned you've got gold in your portfolio, and the comment that you made specifically is, you know, you have to have some in this environment. Maybe if you can just comment on that all round, you know, where are we from a macro cycle, and why then still hold gold?
Okay. Eugene, it's very difficult to trade markets, in our view. The portfolio is made up of individual companies, and each one is an individual story. If you can find pockets of opportunity in each individual story, you can build a very nice portfolio and diversify it. So don't bet the bank on any specific thing. So it's risk on, risk off will very much depend on the opportunities we can find in India, in Japan, a little bit in China, US, Europe, even the UK theme. I mean, it's 9% of our funds just in the equity, the UK pensions market. So that drives our portfolio composition, and much less risk on, risk off. We would be very bad at that. And on your second question, well, gold is a necessary evil. It's not an evil, but I think it just kind of weathers fluctuations and volatility in global markets. And with what's going on in Ukraine, what's happening in the Middle East, I think everyone, when they get a bit nervous, they hold on to gold and they buy more gold. So let's at least have some exposure as some form of insurance policy, and that's really it. And the returns have been good. But we're not over investing in gold, just having some exposure.
One question, last question coming from the audience. Recently, there's been a large pullback in tech stocks. Do you consider this sector to be over or undervalued? Who wants to put up the hand for that?
You do, or you want to go ahead,
Well, on a sector basis, I don't know. It might be, it might not be. On an optical basis, the valuations are high. But it is also an industry where the economics historically have been very favorable. It's a historically low capital intensive industry. It's cash generative. It's scalable. It's transferable across the world. Some of the best businesses in the world is definitely included in those indices with those high multiples at the moment. But we don't have a view of the index like that. We definitely think that there are pockets of opportunity within the companies included in those indices, and those are the companies that we hold.
Gentlemen, I'm going to park it there. And if I could maybe round off with concluding remarks. I mean, with my opening statement, I said, there's a lot of us out there looking for good multi-asset funds where the fund managers pull the levers on our behalf. And Patrice and Henna, I think both of you have illustrated today and over time, looking at your performances, the capabilities of a team, skillful teams that can actually do exactly that for our clients and finding good opportunities in any kind of market cycle. So thank you so much for the great work you're continuously doing. We really very much appreciate it, and for your time this morning. Thank you so much.
Thank you very much, Eugene.
Thank you, VCR. Much appreciated.
Good stuff. To our audience out there, quick reminder, next week, Wednesday, we've got Centaur Asset Management and Corian Capital. Really looking forward to seeing you all again next week, Wednesday. And thank you so much for attending this morning. And we'll chat soon. Hello, Patrice. Thank you so much.